we're gonna get started. So we bring in two experts in their field to talk about the two topics that we think every single investor needs to know. One is the cost seg. So and it's gonna be presented by Brian. And the second one is a 1031 exchange. It's gonna be presented by Greg. So we're gonna jump start and have Greg started the session today when we wait for Brian to come online with us. Just a 2-minute summary about what my team and I do. So if you really even in residential or commercial real estate, we recommend that you check out our website. We try to put a ton of information on our website just so you can get to know more about investment. So this is our website, and this is a little bit about all of our team members. So we do both residential and commercial real estate in Central Ohio. Get to know each of us from here and reach out to us if we can help you broker any investment deal. So I'm gonna let you share your screen, Craig, and you can take it from here.
Thank you very much. Let me find this. There's always this trick to get it to go down. Let's see. All right, no, I didn't bring it up. Let's see. One moment. It likes to do this. It's my PowerPoint's open. It's right there, but it doesn't want to let me get that to one of the choices I can share. Oh, here we go. It's the show all windows button. All right, we're good. Oh. The next trick is to see how you get this bar out of the way so you can actually get to where it says start from the beginning. And how do I move it? Here we go. All right. I've only done this a million times. Every time it's like doing it from the first time. All right. Can you see my screen okay now?
Yes.
Perfect. All right. Well, thanks so much, Tracy. So I'm Greg Smith. I'm with a company called Investment Property Exchange Services, Inc. So we go by IPX or IPX 1031. We're the country's largest qualified intermediary for handling Section 1031 exchanges for folks. And I know a lot of you on the call right now, but there's going to be a lot of people watching this later, the recorded version, who might not be experts on 1031s like many of you. So let's take it from the very top. In its most basic form, Section 1031 of the tax code says that someone who sells real estate, and it does have to be some type of real estate that's either used in a business or held for investment, that they can go out and instead of pocketing that money and having to pay the taxes, they can reinvest into more real estate that's either used in a business or held for investment. And if the investor does that, they can move forward, they can build their empire over time and never pay any taxes on the properties that they're selling. So they defer it and it can become tax-free. And we'll talk about both of those things today. So that's the, very basic idea behind what a 1031 exchange is. But there's lots of different qualifications. And of course, the IRS makes certain things a little complicated. So we'll walk through some of how that works. Now, there are really hundreds of reasons why people use 1031 exchanges besides the obvious of not wanting to pay taxes that you're not required to pay. So it might just be that you own some non-income producing land and you say to yourself, you know what, this is great. This has been getting better and better through the years, gaining value, but I'm tired of just paying taxes on it, not bringing any income. I'm ready to sell that and I'll go buy some rental properties, let's say, and get into something that's actually going to kick off income each month to me. It could be estate planning type issues. You've got kids located in Florida and Texas and California, and you say, well, you know, I'm going to relocate properties near my kids. My kids will learn how to manage these properties. Then when I pass on, I'm going to leave those respective properties to those kids. And the list of those types of things goes on and on and on. It could be as simple as, hey, you just moved from Pittsburgh to Columbus and you had rental properties. You want to keep managing rental properties. You like doing that, but you need to have them close to home, not hundreds of miles away in some other state. So you want to sell your Pittsburgh properties and replace those with Columbus properties. But once you get past all those things, we do want to deal with the obvious. Don't pay taxes you don't have to pay. So a lot of people have 15% on the mind. So as an investor, you might be thinking, well, 15% is not that bad. Maybe I'll just go ahead and pay those taxes, stick the money into the stock market and, you know, what have you. Well, it's never just 15%. So I've seen many clients get a rude awakening through the years when they actually get those tax bills. In other words, it becomes April, they're doing their taxes, their accountant is doing their taxes for them, and they say, hey, here's the checks you're gonna have to write to the state and to the feds for when you sold that property or those properties last year. And they say, gulp, what just happened? I thought it was gonna be 15%. A more accurate guess ends up being about 30%. Now, why is that? Well, yes, the long-term federal capital gains tax starts at 15%, but it can jump up to 23.8% if you hit certain higher income thresholds. And those higher income thresholds don't just have to be your day job income. They're also the gains from your real estate sales and many other things. So instead of 15, maybe it's 23.8. Then people forget about depreciation recapture. That's the idea that buildings crumble away over time. And for commercial property, the government says it should last 39 years. Your commercial buildings will have a 39-year lifespan, and then theoretically, they've crumbled to dust, and you've just got the land value left. And with residential property, it's got a shorter lifespan, 27.5 years. So if you went out and you bought a $5 million commercial property, for easy numbers, they're going to say the land value is $1 million, the improvements, the buildings themselves are worth $4 million. You would take that $4 million and divide it by 39, and that's your tax break you get every year. And that's a wonderful thing for investors because you use that to offset the income coming in on your real estate. Now, the downside of that, however, is years later, you go to sell that property. Well, it didn't crumble away over time. It didn't become less valuable. You are hoping it became more valuable, and often it does. So you go to sell it, and it's become more valuable. Yeah, Uncle Sam's going to stick his hand out and say, wait a minute, I was giving you a tax break based on the theory that is getting less valuable. It got more valuable. We want our money back. They're going to take the total of the credits you received through the years, and they're going to tax that at 25%. So it can be an absolutely brutal tax that you're not always expecting. Finally, there's state tax. In Ohio, it's not the end of the world, but it's another 4% that gets added on. In some states like California, so if you happen to be selling in California and relocating to Ohio with your investment property, California is going to try to hit you at 13.3% if you don't do a 1031 exchange. So without the exchange, it can easily be 30%. There are extreme examples where it's over 50%, but it's never 15%. So you want to know taxes are kind of rough. All right, I'm going to skip through this depreciation page. I kind of mentioned that already. Now, the next thing you want to know about, oh, and I didn't set my alarm, which I'm going to do now to make sure I don't talk forever. So I am going to put on 20 minutes because I know I've already been talking, and then we'll have question and answer. But that way, between what I've already said and everything, I won't talk for too long. Got that going now. All right, so like-kind property. People sometimes hear these 1031 exchanges called like-kind exchanges. That's really almost an outdated notion now because like-kind used to mean something different. Back before the Tax Cuts and Jobs Act, back in 2018, A 1031 exchange could be used for almost anything. It could be used for aircraft. It could be used for business equipment. It could be used for fun things, racehorses, artwork, collectibles. Anything with a capital gain tax could be part of a 1031 until 2018. And the only real exceptions before then were stocks, bonds, and notes. Those were never really 1031 eligible. But after 2018, it's only real estate. Only real estate can be part of a 1031. So that makes like kind very simple now. Like I said at the top, any kind of business or investment real estate can be traded for any kind of business or investment real estate. So like kind is very flexible. It's okay to sell that duplex and buy a commercial property. It's okay to sell commercial property and buy farmland. Anything for anything within real estate that's investment or used in a business. The numbers and how they work in a 1031 to get you 100% tax deferral are not necessarily common sense, and they differ from other tax code provisions like with opportunity zones. With 1031 exchanges, to get 100% tax deferral, you always read what it says in number 1 here: buy property of equal or greater value. Now that's an estimation, because really you can buy something a little less valuable and still get 100% tax deferral based on the fact that they don't go from your gross sales price of the real estate that you've sold. They go by the net sales price. So once you've paid items that are standard on closing statements like real estate commissions, title fees, and so on, that's when you get your net sales price. That becomes your magic number, that if you buy property, it could be one or more properties, but if you buy for equal or greater to that value, you'll owe no state or federal taxes. 2 and 3 are another way of looking at that. Number 2 says, don't keep the cash from the sale. Okay, so if the title company would be handing you a check for $100,000, get that to a company like ours called a qualified intermediary. We'll talk more about that at the end. And we hold the money until you reinvest it within a time frame that we'll discuss. But if you touch the money, it becomes taxable. If you say we're going to get 100,000, but you kept 10,000 of it, that doesn't kill your exchange, but that 10,000 will be considered taxable boot, and you'll end up paying, say, $3,000 in taxes on the 10,000 that you kept. But then number 3, goes hand in hand with that. Replace the debt that you paid off. So if you paid off $212,000 to the bank on the closing statement, the IRS wants to see you go get a new loan of $212,000 or more on your new property. Now, if for some reason you didn't want debt on the new property, or you wanted to have less debt on the new property, you could do that by adding additional cash from outside of the exchange. So even if you paid $212,000 off to the bank, you go buy your new property. If you've got $212,000, burning a hole in your pocket in one of your other accounts, and you decide you'd rather buy for cash, you can add that into your deal and offset the debt with new cash. Number 4 doesn't come up too often. That's received nothing but like-kind property. So what could be non-like-kind? Well, let's say your client sells $1 million of farmland and they buy $1 million hotel. At first, that looks perfect, but if it's already a working hotel, then what you're really paying for is not going to be considered all real estate by the IRS. You're paying for all that furniture throughout your new hotel. You're paying for kitchen equipment, all these other types of things that won't go on your books as real estate. So maybe in that example, your client sold $1 million, farmland, and they bought $700,000 in that hotel, plus $300,000 of non-like-kind property, which would mean that would either become taxable boot, or they'd have to go out and buy a second piece of real estate for $300,000 or more, roughly speaking, to get to 100% tax deferral. So roughly, yeah, buy equal or greater. More specifically, don't keep the cash, replace the debt. Okay. So we often get calls from people, we're walking through how the 1031 process works. Everything looks good. And then I ask them, well, how long have you owned this property that you're selling? And they say, well, I've owned it for 3 months. And I say, okay, we're going to have to discuss that a little further now. The IRS has made sort of a strange test for 1031 eligibility. The test has nothing to do really with how long you've owned the property. Instead, it has to do with what your intent was with that property. So when you acquire a property, if your intent is to hold it and rent it out and be an investor, then it qualifies. Whereas if you buy it with a primary intent of resale, then unfortunately, it typically would not be considered 1031 eligible. They're not looking to give developers, for example, or home builders, they're not looking to give you a tax-free business. So they'd consider that your inventory, like it says in number 1, and that your primary intent is resale. So you do get into a lot of gray areas. So if you're a flipper, but sometimes you maybe rehab and flip, other times you rehab and hold and rent, what does that mean? Well, technically, it just goes back to the intent on that one property. And if you tell the IRS, no, my true intent was to hold it and rent it out for years, but market conditions are so hot, this crazy company in Central Ohio named Intel is coming in, things are going nuts, we decided it was the right time to sell this particular property. Well, that would be a legitimate reason to still do an exchange, even if you never rented it out and only owned the property a very short time. So those types of clients, I say, all right, you put that in your notes, you're probably safe. If they ever ask you the question, you'd know the right thing to say, but you also need to look ahead to the next property you'll be buying. You would not want that to be a flip. If it looks like maybe you flip the first one and then you do flip the second one, they're going to have a lot of reason to maybe shoot down your exchange and make you pay your taxes. So there's a lot of gray area there. In the end, it's up to you if you want to do the exchange or not. Our company is a qualified intermediary. We don't act as the tax police. We don't report anything to the IRS. So it's up to you if you feel like, yeah, I met the intent and I want to exchange. But they're going to look at facts and circumstances. So you'd like those to be on your side. Residences and second homes, those can come into play. A principal residence is not 1031 eligible, but what if you lived there 3 and 4 years ago? Now you've rented that property out the last 2 years, and then you're going to sell it. Well, that's actually a beautiful thing. You can use both Section 121, the principal residence exclusion, and Section 1031 together. And what would happen is if you're a single tax filer, you avoid $250,000 of gain on the sale of your home, even though you turned it into a rental property, because you meet their requirement that you owned it 2 of the last 5 years as your principal residence where you lived. But you've also rented out the past 2 years right before you sell it, so you're 1031 eligible. So a single filer avoids $250,000 of the gain, joint filers $500,000 of the gain, and then if there's gain that's left, you can avoid it through a 1031 exchange. It's pretty neat to use both of those together. We have more time at the end. Maybe we'll go back to that, but I think we'll keep it quick today. All right. Now, there are very important time limits that come into play with 1031 exchanges. From the date that you close on the property that you're selling, the IRS only gives you 45 days after that to identify what you may want to buy. Then you've got another 135 days after that 45-day period for a total of 180 days for the full exchange period where you need to be reinvested in a new property by the end of that 180-day period. Okay, so 45 to identify, 180 to get closed, with both of those periods running from the closing date of the sale. So they don't run from the contract date. The contract dates don't matter. It's closing date. There's no mercy on this. You don't get extra time for weekends or holidays. It's just pure calendar days. So you want to make sure that you're on the ball there. Then they came up with some pretty strange identification rules. So usually it's pretty simple. Most exchanges are pretty simple. You use the three property rule. You can identify 1, 2, or 3 properties that you're interested in buying. If you do that, simple, straightforward, 99% of the time, not a challenge in any way. But when you want to name 4 or more, that's where they came up with something a little more strange. It's called the 200% rule. If you sold for $400,000, your 200% limit would be $800,000. So you could go out and name 8 properties that averaged $100,000 or 4 properties that averaged $200,000. You'd stay below your $800,000 limit and you'd be okay. But you couldn't name another property that would take you over, obviously, the 3 property rule, but also that 200% limit. If you did find yourself in that category, there is that 95% exception you see there. That rarely gets used by exchangers, but it says if you've got more than 3 properties and you're over 200%, you need to acquire at least 95% of the value on your list, and the IRS will accept your exchange. You really want to stay away from that and stick to one of the first 2 rules. All right. So this is pretty cool. This is if you want to go buy a beautiful house on Lake Erie or Hilton Head Island or Florida or wherever you might want to be as your vacation home or your home that you'll later turn into a principal residence. But you say, all right, Greg, I know it has to be business or investment. You know, what if I really just want it as a family vacation home? The IRS came out with a pretty favorable safe harbor. They just said for the first 2 years after you buy it, you've got to rent it out at least 14 days in each of those 2 years. But they also limit your personal use to 14 days or 10% of the total number of days rented, if that gives you more than 14. So if you're renting your beautiful Hilton Head home out 300 days a year, you get 30 days of personal use. You can live with this safe harbor requirement for 2 years. It means you can never be challenged. So once you get to year 3, you could go make it your principal residence. You could make it your pure family vacation home and never rent it out again. That all works at that point if you follow the rules for 2 years. What if you didn't follow the rules? Well, it's unlikely you'll ever be audited, but if you were audited, they would just look at it, they being the IRS, and they would decide if they thought you met the investment criteria for a 1031 exchange, or if it was too much on the personal side, then they could shoot it down and make you pay your taxes. Briefly mention these different types of exchanges. So what we were just talking about with the 180-day period, those are called delayed exchanges. If you swap deeds with your best friend or your family member, that's called a simultaneous exchange. That's where no money changes hands and you're simply swapping deeds. Sometimes there are situations where people need to buy first. So if they want to buy that replacement property prior to the time they sell their old property, that could be for a lot of reasons. It's called a reverse exchange. The IRS gives you a way to do that, but they do not make it easy. They say you can't own the old and the new at the same time. How do you avoid that if you're buying first? Well, our company would set up a new LLC. We have to take title to the new property on your behalf. And then from that closing date, the IRS gives you 180 days to get your old property sold. Let's say it sells out on day 100. Then we turn around and deed that new property over to you, and you've completed your reverse exchange. I'll mention now that standard exchanges are relatively inexpensive. The total fee for most standard exchanges is $1,250. Our company charges $1,000 to set up the exchange and handle the sale. We charge $250 for the replacement property purchase. So 90% of exchanges across the country have a total fee of $1,250. The reverse exchange, where there's much more to it, and we actually have to be in title on your behalf, those can be from about $6,000 to several $1,000s more than that. So you would only do that when you're going to have a serious tax hit, and paying those kind of fees makes sense. Same idea with the next one, the build to suit. This is also called an improvement exchange or a construction exchange. So that's where you either want to buy land and build on it, or you want to buy some existing structures and do significant improvement and rehab to those. So if you're going to be doing hundreds of thousands of dollars of construction, whether it's rehab or build a multi-million-dollar building, let's say, a build to suit could make sense. So you sell something over here, we'll say for $1 million, you buy land for $200,000, but you're putting a $2 million building on it. The IRS gives you a way to count the improvements. Once again, like with the reverse exchange, they don't make it especially easy. We have to take title, and you only have the rest of the 180-day period to see how much you can get done that you can count. The reverse build to suit puts those last two together. You're buying first and doing improvements and then selling. Same types of challenges with the 180-day period there. So some interesting concepts that we do a lot of those. They do help a lot of people, but they're much higher level math than your more simple type of 1031 exchange. All right, I'm going to skip that today. We've just got a couple more minutes before I ask about questions, or maybe Tracy wants to do everyone's questions at the end. We'll find out. Let's just talk about what a qualified intermediary is and the basic process. So if you've decided you want to do a 1031 exchange, you would talk to a company like ours, a qualified intermediary. We would find out what title company you're going to be closing with. We ask that title company to send us a copy of the contract and the title commitment. Once we review those two documents, we draft up the exchange paperwork you need. That includes an exchange agreement as the major document, an assignment of contract, because as the qualified intermediary, we get assigned in where we become the principal on your behalf. And then there's going to be one of those for the new property. We'll get assigned into that as well. And there's several other documents that are part of the exchange process, including the identification form, which has to come back within 45 days after your sale, unless you've already closed on your new property by then, which certainly happens sometimes. So we're setting up a new bank account. We're going to hold your funds. You're going to earn the interest on that bank account while the funds are held. The banks don't like those bank accounts, so don't expect a great interest rate, because they know from the get-go they'll never hold the money more than 180 days. So they can't even think about giving you a 6-month CD rate, for example. You have to be able to get the money whenever you want it, including a day later, which does happen. So on average, we found money is held about 30 days. The banks find these accounts very labor intensive. Everyone gets their own account. It's designated by their tax ID number, either their EIN or their social security number. So people's monies are not commingled. They don't get commingled with company funds or other exchangers. So anyway, don't expect a great interest rate, but you will earn a little interest on that while it's in there. The term qualified intermediary is interesting because it comes from the Treasury regulations. It's capital Q, capital I, qualified intermediary. And yet, this should be frightening. You do not need a single qualification to be a qualified intermediary. It actually comes because you can't be a disqualified party. A disqualified party would be, you can't have your relative be your QI. You can't have your employee be your QI. You can't have anyone you have an agency relationship with act as your qualified intermediary. So you're going to be looking at your attorney can't do it for you. Your accountant can't do it. Your real estate broker can't do it. Anyone that's an agency relationship is out. But once you're not one of those people, now anyone can be the qualified intermediary. So our company, for example, we've been doing this since the 1980s. We've done tens of thousands. We do tens of thousands of exchanges a year across the country. So we've done, I don't know how many hundreds of thousands through the years. I've been doing this now with IPX for a little over 21 years and been with the company for 25 years. So, you know, we're going to have that experience, that safety, but then you need to ask, okay, great. Hopefully you know what you're doing by now, but how are you keeping my money safe? So you need to ask this of any QI. We have good things. We have a $100 million fidelity bond. We have a $30 million E&O policy, but most importantly, we're part of a Fortune 500 company. Our parent company is called Fidelity National Financial, FNF, on the New York Stock Exchange. They, in turn, are the largest title company out there because they own a bunch of the giant underwriters. They own Chicago Title, Fidelity National Title, Commonwealth, and others. That's important because those companies actually guarantee the safety of your funds up to $50 million per exchange. And that's one of the documents you get in your closing package. So You do have to be concerned who you use. There are other good companies out there, but you need to work with big, safe companies that can protect your funds if something goes wrong. So that's important for you to know. And really with that, I want to check with Tracy. Do you want me to take questions now, or did you want to wait till the end? I guess, did you get a hold of Brian?
Sorry, I had to unmute myself.
Sure.
Okay, so we have Joe's gonna jump in and talk just because I actually see the note that Brian actually signing in. There's some technology difficulty, looks like it. So let's do the Q&A for you, Greg, and then we're gonna have Brian speak after that. So I
That's
have
great.
a first question. So let's say my client buy a property to hold, and then just 6 months in, they want to do Airbnb, and then they realize Airbnb is such a hassle, they don't want to do it anymore. Now
Sure.
they put on the market to sell it. Can they use 1031 in that case?
Yeah, I think absolutely. That would be very clear cut that they'd be allowed to use a 1031 because they didn't buy the property with, say, the intent to immediately fix it up and flip it. They bought it with the intent to do Airbnb, or at some point they decide to do Airbnb. So there's clear investment intent. And then they, and I'll say not just in the unlikely event of an audit, but I always love saying this, that in 21 years of this and many, many thousands of exchanges, I've had one client ever get audited. So it's not likely it's going to happen to anyone. The one client, everything went great. They had no issues with the two exchanges that the IRS looked at. The IRS was happy with everything. It was just a random audit. So these are not an audit magnet by any stretch, but if you do get audited, that client would have just the right things to say. I started an Airbnb or tried to start an Airbnb and it just didn't work out. I didn't want to deal with it. I decided it was time to sell and move into something else. So yeah, absolutely. I think they're very safe to do a 1031 exchange in that scenario.
Okay. I think everybody can unmute yourself if you have question for Greg. I see that Mark have a question. Go ahead, Mark.
Hey, Greg, if LLCA is using the exchange and they have multiple LLCs and they want to buy in, if LLCA is selling, can they buy an LLCB?
Yeah, great question, Mark. So the answer starts as it depends. And what the key here is, you've always got to show the IRS that the same taxpayer who sold the relinquished property is the taxpayer that bought the replacement property. So if it's, Mark Sullivan's first LLC was the seller of a property, and you want to go into title in Mark Sullivan's second LLC, then the question becomes, is it the same underlying taxpayer? So if they're both single member LLCs, where Mark is the guy behind both of them, owns 100% of the membership interest in both LLCs, then the IRS is going to say, that's great. Those LLCs don't have to file their own tax returns. They're what are called disregarded entities for federal tax purposes. The IRS ignores their existence. They really look through those. They see Mark's social security number. So the fact that it's even two different LLCs doesn't matter, because both of those LLCs would be filing as part of Mark's personal tax return, and that would work. If it's, Mark and two other business partners in each of these LLCs, then even if it's the same three partners in each, those are two completely different taxpayers. Okay. Each of those LLCs with three members has to file their own tax return, and the IRS would say, no, Mark Sullivan's first LLC and Mark Sullivan's second LLC are not the same. So they would not let you buy the second property in a different taxpayer. So depends on whether it's a disregarded entity or not, and then you might be able to do it. In general, you sell as Greg, you buy as Greg. You sell as Joe's LLC, you buy as Joe's LLC. You sell as Corporation McDonald's, you buy as Corporation McDonald's. but there are some exceptions, like with the disregarded LLCs. So did that answer your question, Mark?
It does. I'm just trying to figure out how do I take how do you take your capital gains and expand upon it by working with somebody else and buying a
Gotcha.
larger property?
Yeah, it can be a little tricky, but there are ways to do it. The most common is if you buy the new property as tenants in common. So let's say you sold your property for 500,000, you want to go buy $1 million replacement property.
Right.
So, Mark or Mark's entity could take title to 50% of the new property. This other guy that you wanted to be your partner comes in and buys the other 50%. And you have to initially own that property as tenants in common. That means you're not a partnership, you're not a corporation. Instead, it looks like Mark owns half, someone else owns half. Then Mark gets credit for his half, defers all his taxes from his 1031 exchange, but you've brought in this other investor, this other LLC, whatever it's going to be. What most accountants tell their clients and most tax attorneys is it needs to show up that way for the same tax year. Once you get into the next tax year, if both of those tenant and common owners want to contribute their interests into an LLC, so now you'd have a 2-member LLC as your investor in that property, they seem to be comfortable with that. You've shown that the 1031 was properly completed, but now you get maybe where you wanted to be in the first place that they wouldn't let you do. They wouldn't let that 2-member LLC, but you get there if you can wait just a little while. So that's a possibility. Now, if the LLC that was your original exchanger was already a true partnership, so there's 2 or more members, another possibility would be make those other investors members of your LLC. So if you've got this LLC with 2 or more members, it sells a property, you want to buy a more expensive property with other people's money coming in, more partners coming in, you can add them as members of your LLC. So that's another way to do it. That won't work when it's a single member LLC as the original exchanger, but it will work with a partnership or LLC with multiple members. So those are 2 possible ways to make that work, but it can be tricky because they won't let you just initially buy in that new partnership. Again, because they would say that's not the same taxpayer that sold the first property on the front of the 1031 exchange.
Understood. Got it. Thanks, Greg.
Yeah. Thanks, Mark.
Greg, it's Zena. How are you this evening?
I'm doing good. Zena, how are you?
Good. So just to expound upon what Mark was talking about. So let's just say that you had 1 or 2 people that wanted to, because you foresee this happening, you're going to exchange and you're going to form a partnership with these other entities. And you were saying to add them to your existing LLC. Is there a time period, or maybe this is kind of way off topic and too complicated, but is there a time period where that needs to happen in, and it has to be a solid LLC with all of the entities in place, a certain time period before you can exchange? Does that make sense?
I think, great question. And I think the best way to do it in most situations is that you would do it after the time the relinquished property is sold and before the purchase of the new property. That way it's clear that this isn't a sale for the LLC. This is a contribution towards that new purchase. Because if you did it prior to the sale of the first property, the relinquished property, that's going to look like you've sold something. You're selling a piece of that old property to these investors. That could cause a tax hit. So you don't necessarily want to do that. And if you do it after you've acquired the new property, same thing. It's really just going to look like you acquired this, you own it, but then you sold off a piece to investors, could cause a tax problem. If you do it in the middle of the exchange, after you've sold and before you buy, that's just like taking on extra investors who are providing the capital to buy the more expensive new property. So that's where the accountant shouldn't have a problem showing them as additional members of the LLC that came in with their additional capital. Now they've got a percentage ownership and it was applied towards this new purchase. So the old members aren't looking like they've sold anything, which they truly haven't, but they would look that way if they did it before that first sale or after the purchase was complete.
Okay, makes sense.
Okay, good. Any other questions for now, anyone?
I have- Okay, you go.
I have one. Okay. Yeah, I'm Kristen. I have a question for my client. And she want to sell her rental property, which she hold for maybe more than 15 years. But now she want to buy a new construction for rental. So
Okay.
the new construction always take maybe I would say a few months. That will still have to meet the 180 days. I know that, but somehow so what kind of suggestion you can give her?
Yeah, so there's a few ways that could work. The most simple way would be if, there's an outside company building that property, they're going to buy this new construction when it's completed, then that's pretty easy. You just have to make sure you'll be able to take title within 180 days after the time you sold the old property. And that's just a simple, straightforward exchange. That's the type of exchange of a total fee of $1,250 when all is said and done. Our company would not need to go into the chain of title to make that work. Or if it's a situation where your client thinks that she's going to need to take title to the land, then have a builder come in and start doing construction, that's where the IRS makes it a little more complicated. So instead, when she's ready to take title to the land, our company would set up a new LLC. We'd take title to that land on her behalf. She and or her lender would still be paying for it, and they'd still be paying for the construction. We would just be in bare legal title. She'll still have full control over the property from day one, but that would be the situation where you only have the rest of your 180-day period to make improvements. It doesn't have to be completed, but she would only get credit for what's done in that 180-day period when we then deed the property back to her at the end of the 180 days. So hopefully it's the easier first scenario where, a builder just gets it built and then she buys it. That's clean and simple. Or she'd have to go the more complicated route where we take title on her behalf.
Thank you.
Yeah, thank you. Great question.
Okay, correct. Can a flipper use 1031 exchange?
Yeah, so it can be difficult. It's a case-by-case scenario. But if they go into a property with the intent to flip the property, they generally won't be considered 1031 eligible. Because if your primary intent is resale, which is what the IRS would say a flipper has, as opposed to your primary intent being holding the property for use in a business or holding the property for investment, which would make you 1031 eligible. That comes down to a lot of gray areas. Sometimes you honestly can buy a property and not know what you're going to do. I'm going to put some work into it, but then I'll figure out if I want to sell it or hold it and rent it. So it's not always clear cut. I think it's a pattern. So if you had a flipper and all they've ever done is flip properties, then they go and tell the IRS they weren't trying to flip one they did an exchange on, that might look bad. They might not win that argument. But if it's someone that always rented properties, had never sold anything in their life, now they buy another one they plan to rent, someone gives them an offer they can't refuse, they sell it after a couple months, it's very clear that person could do a 1031 safely. So the quick answer to your question is flippers usually won't be 1031 eligible, but sometimes they are if their intent was to hold that property for investment, because it's really not what you've done overall. It's supposed to be what was your intent with that one property. You just have to be realistic that what will the IRS be looking at if they were to audit me? And if all you've ever done are flips, it's probably not going to look good. If you've got a mixture of flips and properties you've held for rent, you're going to be a lot safer.
Got it. Look like Anne have a question. You go ahead, Anne.
Hi, Greg. Thank you for the presentation. It was very informative. I do have a question regarding the basic rule where you says have to be equal or greater. Can you elaborate a little bit what is the number you're looking at to say is have to be equal or greater? So I'm
Sure.
going to give you one example just to see if I understand it correctly. Let's say the client purchasing a property for $100,000. Now they sell it for $300,000. The capital gain is 200,000. With that 200,000, that is the profit that we want to exchange. Or we have to buy something greater than 200,000, or we have to buy something greater than 300,000.
Gotcha. Yeah. So you want to think about sort of two different equations in your head, two different math problems. The first would be if you're going to go ahead and pay the taxes. That's where you're definitely looking at, okay, they had bought it for 100,000, they're selling for 300,000. We're just going to keep this real simple. Say they have 200,000 of gain. The 200,000 is what they would look at in tax. So you end up paying, let's say, maybe a 30% tax on that 200,000 of gain. When you're now deciding, okay, my accountant told me those bad numbers, I don't want to pay those tax bills. So you're deciding to do a 1031 exchange. Now you're not concerned anymore with the amount of gain. Now the IRS is really looking at your sale price. The good news is it's not quite the 300,000. It's going to be a little less than that again, because your real estate commissions, your title fees, those closing costs come off the top. So instead of that gross sales price of 300,000, maybe it's the net sales price of 270. And that 270 is going to be built of, maybe you owe the bank 70,000 from when you bought that $100,000 property. Originally, maybe you had a $80,000 loan, but you paid it down to 70,000 by the time you sell. So there's 70,000 of debt being paid off. And then after that, there's 200,000 of cash coming out. Again, because a 300,000 sale, we're saying 30,000 of closing costs, 70,000 paid off to the bank, leaves 200,000 of cash. So specifically, the IRS wants to see you reinvest the 200,000 of cash and then either replace the 70,000 of debt with a new loan of 70,000 or more, or you could bring additional cash in if you wanted to offset the debt that way. So yeah, to answer your kind of initial question, it'd be closer to the 300,000 number. It's not the 200,000 number that you have to replace, but it will be less closing costs.
So it really doesn't matter how much is the mortgage. Even if they have 100,000, 10,000, it's going to be based on the net proceed from the sale that they have to exchange to the new property with that amount equal to that amount greater.
Right. So the mortgage, right, that magic number would be the same whether there's any debt or not, because it is that net sales price. But where the mortgage comes into play is you've got to replace the mortgage debt. So you'd have if you're paying off debt to the bank, you have the option to replace that portion of it with a new loan on the new property. Whereas if you're selling a property that has no debt on it, now you can only use all cash to buy the new property if you were buying a property of the same value, because whatever cash is coming out to you needs to be reinvested. So hopefully I said that in a way that makes sense.
Okay, I'm going to reassure my information to make sure that I understand correctly. So let's say that they have zero mortgage when they sell the property. Now
Okay.
they're purchasing another property. Let's say they're purchasing it for 350,000. The net proceed is 270,000. So now the difference, even though they don't have any mortgage, they could still come in purchasing a new property, taking the whole proceed from the sale, and then they're going to get a loan on it. It doesn't matter if they have the mortgage before or not.
Right. So in your example where they've got 270,000 of cash that needs to be reinvested, they're buying a $350,000 property. The 270 is going to come to us as a qualified intermediary. We're going to wire that into the new closing. And then the client is either going to add the extra 80,000 cash out of their own pocket would work, or they can go get a loan and borrow the other 80,000.
Okay, so it's
Either
really,
one would work.
okay, so it really doesn't matter if they have the mortgage before or not.
Well, I wouldn't say it that way, because it does matter if you have paid off debt or not. It just, you have to replace debt paid off either with debt or cash. But if there's not debt, then you just have to replace the cash. Does that make sense?
I'm sorry, I kind of confused right there. So let's say they have the mortgage of $50,000. Now the
Okay.
net proceed is 220. They go in the purchase of 350. So now with that mortgage, are they obligated to get the same mortgage, or can they come up with just cash?
Right. So in your example, now there's 220,000 of cash and 50,000 of mortgage being paid off. They need to use the 220 of cash, because if they pocket any of that, that portion would be taxable. And then for the 50,000 they paid off to the bank on the closing statement, now they have a choice. They can either get a loan for 50,000 or more, or they could add 50,000 of cash. So once they've done that, they owe no taxes. In your example, they're buying a more expensive property. So of course, that difference up and above their $270,000 number, they can either borrow the rest of that as well as the 50,000 they could have borrowed, or they could add additional cash. So you really just want to think of it as, you don't want to keep any cash from the sale. And if you paid off mortgage debt, you need to replace that with either an equal amount of debt, or you could add cash instead of offsetting it with debt.
Got it. Makes sense now. I have one more question.
Great.
If they were to get a net proceed from selling one property, and now they're looking for a 1031 exchange, but they don't want to put everything in one property, or they couldn't find anything with the same value for one property, how are they going to use up all the cash? Can they buy 2-3 property?
Absolutely. Yep. It's just about those overall numbers. But if they want to buy 2 properties, 3 properties, 5 properties, as long as they can identify those within 45 days under those identification rules, it's perfectly okay to buy multiple properties.
So there is no limit on how many property that they have to buy to exchange.
Yeah, technically right. There's no limits. If you're buying everything in the first 45 days after the sale, you could sort of buy an infinite number of properties. If some are going to close after day 45, you do have to worry about how they fit into the identification rules of the 3 property or the 200% rule. But typically when people are buying a lot of properties, they'll use that 200% rule, and because they're naming 4 or more properties they might buy, and that works out fine.
You know what? You want to really copy the website from Greg right there. He really put a ton of material on his website, and then he put a lot of graphics just to really help the process a little easier to understand. So I think the website is going to answer a lot of your questions, and we have Greg information. So anyone want to schedule a one-on-one appointment with Greg, he can jump on the call and talk to everybody.
Yeah, I'm always happy to do that. So let me be sure to point out, we never charge anything for consultations. We're happy to do phone conferences with you as an investor, or with you with your real estate agent, with your attorney, with your CPA, anyone. We're happy to get together, walk through what works and doesn't work. There's never any charge for that. So don't hesitate to reach out. If you can't find my email address or don't see it on the website or something, just ask Tracy. She'll give that to you. And
I'll send it right after the seminar, so you have it.
Thanks so much. Yeah.
Thanks, Greg.
All right. Anybody else have a question for Greg? You know, actually, I just look at the phone now. It's time for Brian to come in and share with us a ton of information on COSAC too. But Greg, if you want to hang on and see if anybody else have more questions for you, you're welcome to do so. Otherwise, I make sure I'll send your contact to everybody. So, like I said, they can schedule a one-on-one with you.
Thanks. Yeah. Thanks so much. Thanks for having me on today. I appreciate speaking with everyone.